In this video, we're going to be covering the cash receipts budget. So with this one, we're generally only going to have one specific type of receipt, and that's based on our sales. So what sales did we have, and when are we going to collect it? That's really the question that comes into play here. So in this example, this Monacar Enterprises has assembled the following data to prepare for the budget meeting, and we need to complete the cash receipts budget. So again, it's based on sales, but it's not as simple as what sales did we have, we're going to collect it all that month. Instead, we have to take a look at when are we collecting it. But first of all, we do need to know what the sales are. In this case, the sales in January are expected to be $55,000, and they're expected to increase at a rate of 5% per month throughout the rest of the quarter. So they don't give us the actual sales numbers for every month. We have to calculate them, and we need to do that by increasing the rate. So we'll talk about that in just a bit. And then we go to the pattern of collection. So it says based on historical data, 70% of a month's sales are collected in the month of sale, 25% are collected in the following month, and then the other 5% are not even collected at all. They're bad debts. They're not expected to be uncollected, or they're not expected to be collectible. Now that's fine, but we're in January, so we need to know what was last month's. We either need to know last month's sales, or we need to know the cash receipts from last month that were not collected, that are going to be collected in January. In this case, they actually give it to us. They say December of last year's ending accounts receivable balance was $13,500. So that's what we're going to collect in January based on December sales. Now here's the template I've set up. Different textbooks, different instructors might request something slightly different. The yellow rows are informational only. They don't get added to anything. They're information either to calculate something down here or to carry over to the balance the balance sheet for accounts receivable. Because keep in mind, if something was not received in a particular month, that means it's an accounts receivable for the next month. We didn't get cash, but we have another asset, the accounts receivable. So we need to do that. We need to figure out what the amount is for the sales, first of all. In this case, the first month is $55,000. And then we have to calculate February and March. So it's going to be the January sales multiplied by 1.05. And then March will be February sales multiplied by 1.05. So it keeps increasing month after month. Now, we need to know January's beginning AR balance, which is the same as December, last month's ending AR balance. So that's going to be the $13,500 from December of last year. That's just the amount we're going to use. And while we're at it, I'm going to format these amounts so they're all dollars. So that's what we have here. Now, for the chart itself, we need to know what are we receiving in each month. So I'm going to create this, and it's going to be 25% of December's sales collected in January. That's what I'm going to put in here. Now, that 25%, we don't have December sales. They don't give that to us, but they give us the balance itself. They told us what the 25% essentially was, and that's this $13,500. We're not adding it up here. These are informational only, but I brought it down because we need it here. Now I need the other 70% of January's sales collected in January. 70% of the current month's sales are collected that month. So this is going to be 0.7 multiplied by January's sales, 55,000. So now we know everything. We know the two items we're collecting in January, a little bit from last month and a little bit from this month. Now notice the 70 and 25% don't add up to 100%, and they're not supposed to, because 5% are never going to be collected. Now let's go down and we're going to do February. We don't have anything left to do for January, so we're doing February, but we're still putting it in the same row or the same column. Now we're doing new rows. So to make it simple, what I'm going to do is I'm going to copy and paste these two labels And now all we have to do is increment it by a month. Now it's 25% of January sales collected in February, and it's 70% of February sales collected in February. So that's all we're doing in this case. Oops. So 25% of January sales collected in February, our formula is going to be equals 0.25 multiplied by January's sales. And then we're going to have 0.70 multiplied by February's sales. Now, by the way, down here at the bottom I had an ending AR balance. It's informational only. This is basically what amount is going to carry over to the next month. For January, it's the January sales that are not collected until February, which we just did that calculation. It's the $13,750. We're not going to collect them until February. Now, in this row, in this column, I'll do it a little bit differently. For February, it's going to be the other 25% of February sales that are going to be collected in the next month, March. So 0.25 times the $57,750, and that's $14,438. This is going to be collected in March. We'll get to March in just a second. Oh, and by the way, the other thing, whenever you have an ending balance for 1 month, that also becomes the next month's beginning balance. So I'm just going to carry that over here. Now I'm going to copy these labels one more time. And again, I'll increment them one more month. February sales collected in March. And then March's sales collected in March. So now the amount, again, it's going to go in the March column. Now, as you can guess, the February sales collected in March is this ending balance. But we can still do the calculation again. It's 0.25 multiplied by February's sales. And as I mentioned, they need to match. Now we'll do the 70% times March's sales, 42,446, and we're done with the actual collections, but a couple of things to tidy up on. The ending AR balance from February needs to carry forward to the beginning AR balance for March. And then finally we have the last AR balance for March. And again, it's going to be collected in April. That's the remaining 25% of March's sales. Whoops. They're not going to be collected until April in the next quarter. So now we have a couple of things to do. I guess the first thing I want to mention is the quarterly totals, or quarterly amounts, I should say. For sales, we can just do a sum of all 3 months. But for any beginning or ending balance, if you're looking at the beginning of the quarter, it's going to be the first month's beginning balance. So it's going to be $13,500. If you're looking for an ending quarter, it's going to be the ending balance of the quarter, which is the ending balance of the last month, $15,159. Now you could do a subtotal for each of these individual lines, but it doesn't really serve a whole lot of a purpose. What we need instead, we do need to sum up all of our collections for each particular month. So 52,000 collected in January. I'm just dragging the formula over. 54,000 collected in 54,175 in February. And if you highlight those cells, you'll see that the sum is indeed 54,000. I'm going to drag the formula over one more time to get the 56,884 sum of these two amounts. Now finally, the quarterly total is going to be the sum of each of these three. $163,059 is what we have there. So this is the cash receipt amount, which is going to go over to the overall cash budget. So hopefully this has helped you to work these types of problems. We'll be carrying this forward. We'll be dealing with the cash disbursements budget, and then we'll merge the two for the overall cash budget. Thank you for your time.